Alright, now we'll be doing the workings related to the consolidated statement of financial position. So there are 5 workings: 1, 2, 3, 4, and 5. Working number 1 is the group structure. Now, through this working, you will know how much percentage the parent company has acquired in the subsidiary. The working number 2 is net assets of subsidiary. Now, you need to calculate the goodwill in the working number 3, and goodwill means how much more than net assets the parent company has paid to the subsidiary. So that means in order to calculate the goodwill, you have to first of all calculate the net assets of the subsidiary. The fourth working will be the non-controlling interest, and the fifth working is the group retained earnings. So these are the 5 workings you are going to do in relation to the consolidated statement of financial position. Now, if you remember all the previous concepts which we have discussed, the workings are going to be quite easier for you. So we are starting with the working number 1, which is the group structure. How much percentage the parent company has acquired in the subsidiary. Normally this is given in the question, but if the question is silent and there is no percentage written over there, you can simply calculate it. Number of shares acquired divide by total shares of subsidiary, multiply by 100. Now, in order to see the total shares of subsidiary, you have to go in the equity section. And when you go in the equity section, there will be equity shares. And then you see the dollar sign under which there will be the balance written. In the equity shares, it will be mentioned that $1 is the par value of the share. Now, if $1 is the par value of the shares, that means there are 5,000 shares, because 5,000 is the total balance, divide by $1, so that means 5,000 shares. Sometimes it is, for example, 50 cents, or for example $0.5. Now in that case, this means that there are 10,000 shares. So this is the important point you need to see, that how many shares are there. Sometimes students directly pick this thing as the share. This is the balance. Now in order to calculate the shares, you have to see this par value, and then you will be able to calculate the total number of shares. So number of shares acquired divide by the total shares of the subsidiary, multiply by 100. This will give you the percentage which is acquired by the parent in the subsidiary. So say for example, if the parent has acquired 60% shares, then the non-controlling interest is 40%. This is in the basic consolidation. Now the next working, which is very important, is the net assets of subsidiary. Now we'll be looking at the net assets of subsidiary at acquisition and net assets of subsidiary at reporting date. At acquisition means the date on which the subsidiary has been acquired. So net assets of the subsidiary at the date on which subsidiary has been acquired. And at the reporting date means when the consolidated financial statements are prepared. So net assets at acquisition and net assets at reporting date. The difference of these two will be the post-acquisition. Post-acquisition means what the subsidiary has earned after the acquisition. So whatever subsidiary has earned after the acquisition will be shared between the parent and the non-controlling interest according to their set percentage. Alright, so first of all, we will be taking the share capital. Now the share capital at acquisition and at reporting date, it is going to remain the same. So you just go to the subsidiaries individual balance sheet and take the share capital and write it over here. And see, this is the balance, not the share. So you have to write the balance over here. Similarly, you just go to the subsidiaries individual statement of financial position in the equity section, take the share premium, and it is going to be the same at acquisition and at reporting date. And then you will be taking the retained earnings. But this retained earnings is going to be different at acquisition and at reporting date. So at acquisition means this is the pre-acquisition thing which the subsidiary has already earned, and these are the retained earnings at acquisition. And at reporting date means this includes at acquisition plus the profit which the subsidiary has made after the acquisition. So at reporting date means this is the total one, which includes the at acquisition ones plus the profit which the subsidiary has made after the acquisition. And then there will be the fair value adjustments. Now we have already done the discussion on the fair value adjustment. It can be either positive when upward or it can be negative when downward. And similarly, when there is upward fair value adjustment, so you are going to deduct the depreciation at the reporting date. Why we are just taking the depreciation at only the reporting date? Because when you do the revaluation, the extra depreciation is actually charged at the reporting date rather on the same day. So when we are doing the fair value adjustments, we are doing it at the date of acquisition, and the depreciation will be charged at the reporting date. So when there is upward fair value adjustment, the depreciation will be deducted, and if there is downward, the depreciation will be added back. Similarly, the unrealized profit, when subsidiary is the seller, then unrealized profit will be deducted from the reporting date. And now other adjustments, it can be either over here or at the both ends. Other adjustments may include, for example, any asset to be written off. Like for example, there is some asset which is recorded in the subsidiaries book, but now it does not worth anything, so you have to write it off. So you will be writing it over here. Any liability to be recorded or removed. In other words, if you want to record any asset of the subsidiary, or if you want to remove any asset of the subsidiary, if you want to record any liability, or if you have to remove any liability related to the subsidiary, then you can do those things in the other adjustment column, because these are all the adjustments which are related to the subsidiary. So when you total this is net assets at acquisition, and this is net assets at reporting date, and the difference between these two is known as the post acquisition, which will be shared between the parent and the NCI according to their set percentages. So remember, working 2 is very important, because if you are not sure what are the net assets of the subsidiary at acquisition and reporting date, you won't be able to calculate the goodwill and the post acquisition thing. Now we will be talking about the working number 3, which is goodwill. Now the first thing you see over here is the consideration, and it has many elements as we have already discussed. It can include cash, or it may be loan notes, share exchange, contingent consideration, because these two are recorded at the present value, deferred consideration. These all will be the considerations. And then you are going to add the non-controlling interest. Now again, the debate is why we are adding the non-controlling interest into our consideration or the parent's consideration. Say for example, parent has acquired 80% of the subsidiary. So this payment represents the 80%. And as I've already told you, we are going to consolidate 100% subsidiary. We are including all the assets of the subsidiary, all the liabilities. Technically, we should take the 80%, but we are taking 100%. So for that, we will be presenting the non-controlling interest, which is the portion which is not owned by us in the statement of financial position. So when we are deducting 100% net assets of subsidiary in order to calculate the goodwill, it is not possible to deduct 80 out of 100. So you have to add the worth of other 20% as well. So when you add other 20%, it will make 100% consideration, and then you deduct 100% net assets in order to calculate the full goodwill. So this goodwill which is right in front of you, goodwill on acquisition, is actually the full goodwill, because you are taking 100% consideration and then you are deducting 100% net assets. That is giving you the full goodwill. The non-controlling interest has two methods: fair value method and the proportionate of net assets method. So if the fair value method is given in the exam, then the fair value will be given, or you just calculate it by taking subsidiary share. When you take total subsidiary share and multiply it by NCI percentage, it is going to give you NCI shares. And when you multiply it by the fair value of the NCI share, it will give you the worth of the NCI. This is the simple fair value method. Either the fair value will be given, or you can use the shares to calculate the fair value. In the proportionate of net assets method, what you are going to do is you take the net assets at acquisition, these ones, and then you multiply it by the NCI percentage. So net assets at acquisition, which is calculated in the working number 2, and you multiply it by NCI percentage and you calculate the NCI worth. So this is the goodwill on acquisition, and we have already studied that goodwill has the indefinite life, so it is going to be subject to the impairment. So there will be impairment. Now in the F7 exam, impairment is given, and in the SPR exam, impairment needs to be calculated. So impairment is simply for the calculation of impairment, you need the carrying value, and then you need to compare it with the recoverable value. So in order to calculate the impairment, the carrying value will be compared to the recoverable value, and this is the value that will be presented in the statement of financial position. And we are talking about the positive goodwill, because the negative goodwill is recorded as an income in the statement of profit or loss, consolidated statement of profit or loss. So this is the working number 3. Now there is a working number 4, which is the non-controlling interest. Now I have already told you that because we are consolidating 100% subsidiary, because we are consolidating 100% subsidiary, we need to present NCI in the consolidated statement of financial position, which is the portion not acquired and owned by parent. So how you will be calculating this? You will take the NCI at acquisition, which is the figure coming from working number 3. And then you will be having NCI share of post-acquisition reserves. From working number 2, there will be the post-acquisition thing which will be shared between the parent and the NCI. And then there will be NCI share of impairment only in the fair value method. We are not going to take the impairment share in the proportionate of net assets method. So this is the NCI which will be presented between equity and liabilities, because this is neither the equity nor the liabilities. This is the portion which is not owned by the parent. And then you will be having the working number 5, which is the group retained earnings, and you will see all the adjustments related to parent in this working, because I have already told you that we are going to take the equity of the parent only. So all the adjustments of the parent. And remember, we are going to take all the adjustments which are related to the profit or loss. Anything which is related to the other comprehensive income or other components of equity should be dealt separately. So I'm going to write it over here. The other components of equity is a separate working, because this is the retained earning, the realized thing, and other components of equity is the unrealized stuff. So the group retained earnings will only show all the adjustments which are related to the profit or loss. So how are you going to calculate it? First of all, you will be taking the parents' retained earnings, and you will be taking this from parents' individual statement of financial position. And then you will be giving the parent share of the post acquisition. Then you will be giving the parent share of impairment. Again, you see impairment is the loss which should be treated in the profit or loss. That is why we are treating it over here. Similarly, unwinding of discount, which was the finance cost. Acquisition cost to be expensed out, such as due diligence fee, professional fee. It should be expensed out, not capitalized. Post-acquisition profit from associates, because I told you that it is going to be recorded in the consolidated statement of profit or loss. So anything which is related to profit or loss will be coming here. Similarly, if there is any bargain purchase like negative goodwill, that is recorded as income over here. So other gains and losses such as negative goodwill, or any gain or loss which is related to the profit or loss, and it should be related to the parent only, not subsidiary, because any gain or loss related to subsidiary should be dealt in working number 2. And if the parent is the seller, then unrealized profit should be deducted from here. So this is the group retained earnings which will be recorded in the consolidated statement of financial position. Now, this is the basic format right in front of you. There are many things, so you cannot learn all those things. Just do remember that any adjustment which is related to the parent, and the second point is that it should be related to the profit or loss, not the other comprehensive income or the other components of equity, because that has a separate working. Now, we have already discussed the unrealized profit on the goods sold by parent to subsidiary or subsidiary to parent. But sometimes the parent and the subsidiary are selling the non-current assets to each other. So if they are selling non-current asset to each other on profit, again there will be the concept of the unrealized profit. So the concept remains the same. If the subsidiary is selling that thing, the unrealized profit should be deducted from working number 2. And if the parent is the seller, then unrealized profits should be deducted from working number 5. But the debate is that how we should be calculating the unrealized profit. In the same way that group companies may trade goods for resale at a profit, they may also trade non-current asset at a profit. Again, the unrealized profit must be removed and the concept remains the same, the single entity. There's an illustration to understand that how the unrealized profit on the non-current asset makes the difference. Parent buys a non-current asset for 100,000 on 1st January 20x5 and it depreciates the asset over 10 years on a straight line basis. So that means 100,000 divided by 10 is 10,000 per year depreciation. On January 20x7, that means after 2 years. So after 2 years, what would be the carrying value? The carrying value would be 80,000 because deducting the 2-year depreciation. The parent sells the asset to subsidiary for 98,000. Subsidiary depreciates the asset over remaining 8 years of its useful life. Now, the carrying value was 80,000 and they have sold for 98,000. So the profit is 18,000. This is the profit on disposal. Profit on disposal. Now, the subsidiary has purchased for 98,000 and now they will be depreciating the 98,000 over 8 years of remaining life. 3 problems arise when the consolidated accounts are prepared. The profit on disposal of 18,000 is unrealized and cannot be reflected because of the single entity concept. From a group perspective, the asset must be recorded at cost less depreciation. And depreciation should be on the basis of the parent's cost. Like for example, the depreciation normally would be 10,000, which is 100,000 divided by 10. Now subsidiary has purchased the asset for 98,000 and will be dividing it over the 8 years, which is the remaining useful life. Now what should be the depreciation? What should be the depreciation? So 98,000 divided by 8. So it is 12,250. The normal depreciation would be 10,000, but now the depreciation which is coming is 12,250. So this is how it makes the difference. How to calculate the unrealized profit on the non-current asset? So the easiest way of calculating is to compare the carrying value of the asset now when the subsidiary has purchased it and the carrying value had the asset not been transferred. Now you can see simply, if this asset would not have been transferred after 3 years, the carrying value would be 70,000. That means 100,000 minus 3-year depreciation of 30,000. But now this has been sold to the subsidiary. Now this has been sold to the subsidiary. And at what amount? 98,000. So 98,000 minus 1-year depreciation, which is 12,250. Now the carrying value is 85,750. The difference between the carrying value now and the carrying value that would have been if there was no sale is the unrealized profit. And you can also calculate this way by taking profit on disposal, which was 18,000, minus the excess depreciation, which is 2250. this is the same. So this is how you calculate the unrealized profit on the sale of the non-current asset. So if the parent is the seller, it should be deducted from working number 5, and if the subsidiary is the seller, it should be deducted from working number 2. So this is another important concept that you need to remember. My dear students, now we'll be doing the consolidated statement of profit or loss. And the good thing is that the consolidated statement of profit or loss is a bit easier than the consolidated statement of financial position, because in the consolidated statement of profit or loss there will not be too many workings which we have seen in the consolidated statement of financial position. The first thing you need to understand whenever you are dealing with the consolidated statement of profit or loss is the mid-year acquisition. If there's a mid-year acquisition, for example, the subsidiary has been acquired midway. Now, midway doesn't mean exactly the midway. It can be any month. So if the subsidiary has been acquired midway, then all of the things of the subsidiary, sales, cost of sales, GP, everything, you are going to take all those figures on the pro rata basis. That means months by 12. So this is the important thing you need to remember whenever you are dealing with the consolidated statement of profit or loss. So the first thing you're going to see is when the subsidiary has been acquired. If it is acquired midway, then all of the things including sales, cost of sales, GP, all of the components of the profit or loss are going to be prorated. Now we'll be dealing with the basic principles of the consolidated statement of profit or loss. So these are the essential things you need to understand whenever you are making the consolidated statement of profit or loss. Again, the consolidation is done on the single entity concept basis, and the consolidation is done on the line by line basis. So there are two things you need to remember. There are two bases you need to remember. The first thing you need to remember is the single entity concept. Single entity concept. That means we are doing the consolidation based on the principle that parent and subsidiary is a single entity, because the parent is having the control over the subsidiary. So in substance, this is a single entity and their financials should be presented in the consolidated way rather than presented in the individual way. That doesn't mean that the parent is not going to prepare the individual financial statement or the subsidiary is not going to prepare the individual financial statement. They are going to prepare it, but we are talking about what will be presented, what will be published. So the consolidated financial statements will be published by the parent entity. The second thing you need to understand is line by line basis. The consolidation is done on the line by line basis. Like for example, you take the revenue, parents revenue plus subsidiaries revenue. Again, expenses, parents expenses plus subsidiary expenses. And if there are intra-group transactions, like for example, intra-group interest, intra-group dividends, all those intra-group uh, balances will be eliminated and will be removed. For example, if the parent company has given the loan to the subsidiary. So if the parent company has given the loan to the subsidiary, in the parent books there will be interest income or investment income. In the subsidiaries books, that will be the finance cost. So you have to remove this thing from the parent books as well as the subsidiaries book. That means interest income or the investment income plus the finance cost will be eliminated. Similarly, if the parent or subsidiary has given the dividend to each other, that dividend will be eliminated or removed as well. So these are the basic things you need to remember whenever you are preparing the consolidated statement of profit or loss. Mid-year acquisition, I have already described this thing to you, that first thing you need to see when you're preparing the consolidated statement of profit or loss is the mid-year acquisition, because we are going to take the subsidiaries, sales, cost of sales, and everything months by 12 in that case. That means on the pro rata basis. Uh, Whenever you are dealing with the consolidated statement of profit or loss, the few things you will see, uh, including the mid-year acquisition, including the intragroup balances, is the impairment of the goodwill. Impairment of the goodwill. Now, we are talking about the positive goodwill, which has been recorded in the consolidated statement of financial position as an intangible asset and as a non-current asset. And we know that this goodwill has the indefinite life. And because this goodwill has the indefinite life, this should be tested for impairment. And impairment means there will be the fall in the value of the goodwill and due to indicators. So if there is any impairment, then that means credit will be the goodwill because the goodwill value will be reduced, and debit will be the profit or loss because this is known as the impairment. So if there is any impairment, that will be included in the consolidated statement of profit or loss. Now this is the basic format right in front of you. There can be so many things specific to the exam question, but we are talking about currently the basic format. So first of all, you see the revenue. Take the revenue of the parent plus subsidiary, but remember you have to do it months by 12 if there is mid-year acquisition. And in the statement of financial position, you are removing the intra-group balances, receivables and payables. Here you will be removing the intra-group sales and purchases, because if the parent and the subsidiary has sold goods to each other, so for one that is going to be a sale and for other that is going to be the purchase, and purchase is recorded in the cost of sale. So you have to remove the intra-group sales as well as the cost of sales as well as the purchases. And now unrealized profit will be eliminated as well. So if you're looking that why we are adding this up over here, the logic is unrealized profit is present in the closing inventory. And if you want to remove this from the closing inventory, you have to add that thing over here. And this thing is the fair value depreciation. If you remember from your final accounts, whenever we charge the depreciation, we usually allocate that thing to the cost of sales. So this is the depreciation on the fair value adjustments. That is why I'm calling this as a fair value depreciation. So it is on the upward fair value adjustment. If it is on the downward, then you're going to deduct it from here. So when you deduct the revenue and the cost of sale, you will get the gross profit. And then you will be having distribution cost of the parent and plus subsidiary. But remember, if there is mid-year acquisition, everything will be prorated. That means months by 12. Then you have the administrative expenses, investment income, all the investment income of the parent plus subsidiary, but you have to eliminate intra-group interest and intra-group dividend, which is the concept I have already told you over here, that if the parent or the subsidiary has given the loan to each other, so for one that is going to be interest income, for the other it is going to be the finance cost. You have to remove for both. You will be removing the intra-group interest from the investment income as well as from the finance cost. So when you take the finance cost, that will be parent's finance cost plus subsidiary, and this is the unwinding of interest which was on the contingent or deferred consideration. And then there will be the impairment of the goodwill, which is the loss you are charging based on IAS 36. Share of profit from associate. I told you that we are doing equity accounting for associate. There was one figure that I showed you when we were dealing with the statement of financial position. And now this is the other figure which you are having. Share of profit from associate, and if there is any impairment, you will deduct it from here. Then you will get the profit before tax, PBT. After that there will be tax and then the profit for the year. After that there will be other comprehensive income, like if there are any gains on investments, for example IFRS 9 financial instruments, or for example if there are any gains related to IAS 16 property, plant and equipment revaluations. Then you will get the total comprehensive income for the year. One of the most important steps that you need to remember is that this profit which you have calculated and this total comprehensive income should be distributed between the owners of the parent and the NCI. That means you have to distribute this thing between the parent and the non-controlling interest. But the biggest mistake students do is they take this figure and this distribute it on the set percentages. Now why this is wrong? This profit for the year is the consolidated profit of the parent and the subsidiary. And we have to give the profit of subsidiary to the NCI, rather the profit of parent plus subsidiary to the NCI. So if you are taking this figure to distribute, this is going to be the biggest mistake because this includes the parent profit as well. So for distributing the profit for the year to the NCI and the parent and the total comprehensive income, you have to do an extra working, and which is presented right in front of you. So what you're going to do is take the subsidiaries profit after tax from where? From subsidiaries individual financial statement. From subsidiaries individual statement of profit or loss. Multiply it by the NCI percentage and multiply it by months by 12 if there is mid-year acquisition. Then this figure is the share of profit distributed to the NCI. But before distribution, you have to do some adjustments. Now, if you are thinking that we have already incorporated the depreciation and the unrealized profit and the impairment in the consolidated statement of profit or loss, you are right. But if you see, we are taking the subsidiaries profit from the individual financial statement, and the individual financial statement, these are not adjusted. So you have to adjust these things. Three things: the fair value depreciation, unrealized profit if subsidiary is the seller, and impairment. And you multiply it by NCI percentage. The net figure you will get is the profit attributable to the non-controlling interest. So you will take this figure over here, and that NCI figure will be presented. Now how you get the parent's figure? The parent figure will come as the balancing figure. Just compare profit for the year with the NCI figure, and rest is the figure that will be distributed to the parent. Now I'm going to tell you again that don't take this figure for distribution because this includes the profit of the parent as well, and you have to distribute the parent of the subsidiary only. So you have to do an additional working. In the additional working, you will take the subsidiaries profit from subsidiaries individual financial statement. You multiply it by NCI percentage and the mid-year acquisition. Then you have to perform three adjustments if there are in the question, because these adjustments have been accounted for in the consolidated financial statement but not in the subsidiaries individual profit. And these are the adjustments of the subsidiary: depreciation, unrealized profit, and impairment. The net figure is the profit attributable to NCI, which you take over here. How you will calculate the parent's share? You just compare the total profit with the NCI's figure, and rest all the profit is for the parent. And the similar thing will be done with the distribution of total comprehensive income. So this is a technical step you need to remember whenever you are preparing the consolidated statement of profit or loss. Now, unrealized profit in the non-current assets. We have already discussed this thing when we were doing the consolidated statement of financial position. That if there is a transfer of the non-current asset between the parent and the subsidiary, there is going to be unrealized profit which should be removed. If the parent is the seller, it should be removed from the working number 5. If subsidiary is the seller, it should be removed from working number 2. But how are we going to calculate it? So if the transfer is in the current period, that means this year the transfer has been made, then the unrealized profit includes two things. The first thing is the profit and loss on disposal, because according to the single entity concept, these companies, parent and subsidiary, should not charge anything to each other. And the difference between the new and old depreciation. Remember, in the statement of financial position, in the consolidated statement of financial position, we were comparing two carrying values. Carrying value which was after transfer, and the carrying value assuming there is no transfer. And the difference between these two was the unrealized profit. But here you're going to compare the new and the old depreciation, and I told you this thing over there as well. So the profit on disposal and the difference between the old and new depreciation. And if the transfer has been made in the previous period, then only the difference between the depreciation is going to be the unrealized profit that should be removed from the consolidated statement of profit or loss. So the consolidated statement of profit or loss is quite easier than the consolidated statement of financial position. All you need to do is to remember this thing, which is the distribution of the profit between the NCI and the parent, and then removal of intragroup sales, removal of intragroup purchases, removal of unrealized profit, allocation of fair value depreciation, removal of intragroup interest and finance cost, removal of intragroup dividends, unwinding of interest should be allocated to the finance cost, impairment of goodwill should be charged, share of profit from associate should be recorded. These are the main things that you should remember, and rest will be relevant to the question.